and that's called repurchase agreement. Well, in the last video, we discussed about the business of investment banking, how they earn their revenues, how they earn their returns, and earn the name for their investors. But in this video, I'm going to be talking about how a commercial bank borrows money from the central bank. In simple words saying, if a deposit holder tries to withdraw more than 90% of his deposits, what happens to the banks now? Because banks usually have 10% reserve requirement, minimum. And that's where the repo market will get in action. Now let me first clear out what is repo. It sounds a very crazy name in finance. And that's repurchase option agreement, in which central bank, in India we have RBI and US Federal Reserve, in which a central bank lends money to the commercial bank with an interest rate, and that's called repo rate. And allow me to just clear out how this repo system works. Now let's say a bank is in short of funds right now and they need to raise cash quickly. Now we'll not target capital markets and allowing new investors to enter in the bank, but we'll talk about targeting that bank in which we can trust or we can count on. So commercial banks will target the central bank and they'll borrow money like nickels and dimes, as compared to capital markets, and shareholders are expecting a good rate of return on their investment. So executives of banks will take a meeting with the central bank and they'll ask for short-term borrowing. Back in old time, it was just, I guess, an overnight process. They were given 5-6 hour window where they can actually purchase their agreement option. But nowadays, as government has advanced their regulations, so we have a 7-day window. So it's a long time where the borrower can pay the interest payments according to the borrowed amount. Now, as we go along in this repo process, you should have one thing that should be cleared in mind, that banks are borrowing money from the central bank. Not the central bank is borrowing money from the commercial bank. That's called reverse repo. That's another topic, we'll discuss it after some time. But the thing is, then when a bank is borrowing money from the central bank, and I'm highlighting this all the time, that bank is borrowing money from the central bank. When a bank is borrowing money from the central bank, RBI or Federal Reserve as central bank, they're expecting interest payments to be paid back in full once the time period gets over. And you know what's the beauty of this repo deal? That nobody gets hurt. If the commercial banks are defaulting on their payments, on their interest payments and the principal amount, RBI, the central bank, can sell government securities as collateral in the open market. So let's just imagine if central bank is giving 100 million to the commercial bank, and if that bank is defaulting on that 100 million plus the interest payments, because the interest rate of repo market is 4%. Now the interest plus principal amount, that's 104 million. So if the bank is defaulting on that 104 million, central bank can sell 104 million worth of securities of government in the open market tomorrow. Well, now question may arise that how can repo rate, which is 4% right now, it was 6% a year back, which is decrement of more than 25 basis points every month. How can that decide, how can that control and accelerate inflation, which is price hike, and growth of the economy? Now first, in terms of inflation, let's say RBI decides to increase the repo rate. Now by increasing repo rate, then eventually interest rate on the loan, simple loans, will also get increased. Now people will not spend more money on loans because the interest rate is very high. Now by not spending more on loans, then money supply will eventually decrease, thereby decreasing the money spending. Now if the money spending is low, then eventually demand of products will also get decreased, thereby decreasing their prices. And that's called opposite of inflation. That's deflation. Now, secondly, in terms of growth of the economy, it's the opposite. Let's say RBI decreases now, this time repo rate. We all got that if repo rate is getting decreased, then loans, interest rate on loans will also get decreased. Then money supply will increase, thereby increasing money spending, thereby increasing prices of products, thereby increasing demand of products, and then eventually GDP records will break out. So RBI usually fluctuates and pushes down and then increases repo rate in order to fluctuate the economy, because these two parts are very important in terms of repo market. So I hope you understand how this repo system works. So I'm gonna take a leave, but by the next week I'm gonna be coming up with a new video that's gonna refresh your mind with finance. Till then, take care, be safe, enjoy your life to the fullest. God bless.